Hello everyone, you're welcome to this chapter of Principles of Lending from the course on Credit Professional. It's a course certified by IIBF, Module A Introduction and Overview of Credit. Now, this is going to be a very interesting certification course which I'm sure will help you to get a lot of professional expertise. Now, banks are financial intermediaries. Banks perform the role of resource allocation by moving idle funds to the productive users. The depositor's primary concern is that he or she should get the money back when needed. That is safety of funds. Secondly, he wants or he would like to get some income, which is interest from the funds placed with the banks. Now, some of the depositors would like to receive the income on regular basis, say monthly, and some of them would like to reinvest the income so that they earn more income. You must have heard the saying, money makes money. And when it comes to reinvestment of the interest and earning interest on the reinvested interest with the effect of compound interest, it is going to change your fortune. All the depositors seek the convenience of being able to issue checks and have access to ATM cards to make payments. Thus, safety, income, and ability to make payment and the liquidity requirements will determine or the type of deposit and the period of placement. Now, one of the important reasons for flow of deposit to banks is the regulation by the central bank of the country. Now, regulation results in high public confidence. Now, imagine you are in a country where the banks have no regulator. Will the public believe on that bank? Will you go and deposit your money in a bank which is not regulated? I'm sure you will not. Now, banker has a fiduciary relationship with the depositor. He must deploy the funds usefully and safely. So, it is the responsibility of the bank to manage the money of the customer. The customer puts his money in the bank only on the basis of confidence, credibility. Banker must deploy the funds in activities that produce income, while at the same time the money is safe and liquid. But for the banker, what is the purpose? What is the benefit if the money does not earn anything for him? So, whatever money you deposit, the banker will use the same money to lend to other people and earn interest on it. And obviously, that will be on a higher interest rate. Only then the bank will earn profit. Now, efficiency in lending function is very important for the bank. Banks also undertake investment to earn interest and other income. Now, banker adopts many strategies such as margins, sublimits, pricing, diversification, product mix, so that the lending function is viable. Lending function is the core function of the bank. No bank can function without lending. The banker appraisal and client management skills are crucial for the success of lending functions. So let us learn some of the principles of sound lending. First is safety. Now, by far the most important principle of lending is the safety of funds. An advance is safe if it is repaid as per the agreed terms. The banker must therefore see if the enterprise or the person seeking the loan shows the potential to repay the loan. The enterprise must in fact prove to be profitable. That is, it must be able to service the loan, service the interest, meet the cost of business, and make profit. Repayment of loan depends upon the enterprise, which is an important as success of the enterprise. Now, banker must carry out an appraisal exercise to validate the facts and figures presented by the applicant for loan. The appraisal helps in verifying the fact and see if the facts are correct. that the business is well managed and that business is run profitably. Appraisal helps to establish if the loan and the other dues will be repaid out of the profits made in the business. Yet there is always the probability that income will vary and there could be other difficulties in view of the banker. And in case this happens, the banker would like to insist on some security or collateral. Therefore, appraisal also includes the process of assessing the value of security collateral offered to ensure that it is adequately covers the loan exposure. Now, appraisal is essentially an evaluation of the past performance of the enterprise and the estimation of the reasonableness and correctness of the estimated future business and cash flows. Banks have access to many appraisal tools. Today, credit officers make more objective and detailed assessment of credit risk. They use tools like cash flow analysis, NPV, break even analysis, discounted cash flow, sensitivity analysis, Altman Z score, credit grading of the borrower enterprise, etc. The analysis is done with dual perspective business and management risk. Business risks are systematic and are measurable. Management specific risks have still to be subjectively assessed. Now, though an enterprise is healthy and efficient, external factors may be challenging, such as the situation in the market, such as the industry in which your customer belongs to. Now, let's talk about another important aspect, which is liquidity. Now, commercial banks are essentially short term lenders as they have to repay the depositors as and when they mature or demanded. A substantial portion of the deposit are in the form of saving in current account, wherein the depositor can withdraw the money anytime he wants. These deposits are essentially repayable on demand. Now, you must have heard about the word or the phrase asset liability management. Now, it is an important management function of a bank which is aimed to ensure that the bank does not face a liquidity crisis. Reserve Bank of India requires banks to monitor their structural liquidity on daily basis and submit a statement to the RBI once in a month. The statement monitors liquidity mismatches at 1 day, 2 to 7 days, 8 to 14 days, 15 to 29 days and 30 days 3 months interval. The mismatch in the interval and cumulative mismatches are calculated and position monitored for ensuring dynamic liquidity. Let's talk about another aspect which the bankers keeps in his mind, which is profitability. Commercial banks are for profit organization. Price is nothing but the rate of interest charged for the loan account. Rate of interest on advance depends upon the category of advance as well as the credit rating of the borrower or the risk perception. A bank cannot lend below marginal cost of funds based lending rate, which is MCLR, since April 2016 as against the base rate. Now, a customer with high credit rating, which is lower risk, is charged a lower rate of interest, which is MCLR plus a lower premium. And one with low credit rating, that is high risk, will have to pay higher rate of interest, which is higher premium. Managing the risk in lending is a core function of the lending department of the bank. If a loan is not conducted satisfactorily, serviced and repaid on schedule, and there is delay or default in meeting a deposit falling due, the bank runs the risk of losing its reputation. Another important factor is purpose of loan. Now, banks lend for productive purposes such as working capital needs of business enterprise or term loans for capital expenditure. Banks will not lend for speculative purpose in any sector. Reserve Bank of India has issued instructions regarding the sector for which loans cannot be given. Banks also lend for purposes such as personal loan for meeting medical expenses, educational expenses, leisure travel and tour, for acquisition of personal cars and two-wheelers, housing loans and so on. These go under the name of retail loans. The advent of technology has made more retail loans possible as well as easier. Banks also lend for agriculture and micro, small, and medium enterprises. Let's talk about diversification of risk, which is another important principle of lending. Diversification is another important principle wherein a banker should avoid concentration risk, that is, not expose the bank to a single group or borrowers or for one purpose or geography. Banks should have a good mix of business and should not lend only to one sector or area. This is achieved by prescribing caps on lending exposure limits to each sector, such as steel, cement, textile, pharmaceuticals, etc. They should also have cap on individual borrower and group exposure. Bank would like to earmark funds for corporate, priority sector, and retail. When the risk is spread across wide spectrum of industry and trade and different cross section of borrowers, the banker minimizes the risk to the loan portfolio. So I hope this chapter would have given you valuable information. Let me ask you certain questions so that your understanding can be checked. Question number one: basic principles of lending involve. Now you can answer all the principles which you have just learned. Question number two: what is meant by liquidity for a banker while lending? Question number three: what is meant by diversification of risk? I'm sure you will be able to answer all these three questions easily, and I'm also sure you would have learned a lot from this video. So if you like this video, you can press the like button, subscribe to our channel, and share it on social media. Thank you. Have a great day. Bye bye.